When I started in lending well over 10 years ago, I was looking for any way possible to have an unfair advantage over other loan officers so I can secure more business. And in this video, I want to share with you the three different things that you can do, the three things that I've learned that just by doing them, you have an unfair advantage over any other loan officer. And it really brings in the client a lot closer to you. Your opportunity to close a transaction goes up, in my opinion, by well over 90%. And so if you're trying to figure out, as a loan officer, trying to get into the business, you want to learn more about it, what would be the best way for me to approach a client without being salesy, none whatsoever, yet still earn the opportunity to get to the business 10 to 1 over another loan officer? This might be a perfect video for you to watch. My name is Zevi Shaffer. I'm an owner of a wholesale mortgage business called Loanbrook Inc. in Los Angeles, California. I've been doing this for well over 10 years, and I can tell you that when I first started, and I knew nothing, I was actually teamed up with a top producing loan officer. And basically the approach was, I started on the bank level, and they teamed us up and they said, look, this person right here is literally our top producing loan officer. And I know him, ironically, he was a friend from a very long time ago. And so they set us up to basically be in the same branch for 3 days. That's it. That's all I got with him. And they said, look, by hanging out with this person for the next 3 days, you get the opportunity to see what it is that they do that sets them completely apart from all the other loan officers. You get to learn from them, which is huge. There's nothing better, in my opinion, than having a strong mentor, because you could speed up the learning process simply by following whatever someone else who's already been there is doing, especially if they are the top person in the space. So for me, that was this person, and I got the opportunity to basically hang out with them for the next 3 days and see what it is that they do. Now, mind you, you're in a bank. There's not a ton of action. So for the most part, I get the opportunity to pick their brain, and I ask them, I said, hey, let me ask you this. What is it that you think that sets you apart from everyone else? And there's one thing that they told me that I will never forget. They said, listen, the first thing you want to do when you talk to anyone who has remote interest in a transaction is take the loan application. All right. So that was basically a light bulb moment for me. And it might sound silly to you, like, well, if someone's interested, wouldn't you want to fill a loan application? Mind you, in this technology era that we're in, a lot of loan officers might say, let me just give you my card. It has a link to the application. I'll send you a link to your email, complete the application. Not this person. He told me very specifically, he said, Zevi, look, you learn everything by taking the loan application from this individual. You get to ask all the questions that you need to know to basically figure out what will be the best loan program that would be available for them. By taking the application and even asking these questions, these are very personal questions to their finances, you're going to naturally build rapport, which is something that many other loan officers might overlook. Now, mind you, this is something that you do day one. You know, first conversation you're having with this individual, they're telling you, look, we're thinking about getting a loan. Take a loan application. The reason is they're now in a state of mind of wanting to get a mortgage, wanting to get pre-approval, pre-qualified. You have no idea who else they're going to be talking to over the next week, over the next month. So just by them giving you some information, you sending them your email, telling them how reputable you are, doesn't mean you're going to earn the business. But when you take a moment, pull the person over, sit them down, have a conversation with them, start taking their loan application, you're basically going over everything. Mind you, a loan application is basically a framework of their information, their income, their employment, their assets. That's a lot of information to cover with someone who is in a mind frame of shopping for a mortgage just by taking the loan application. And think about this for a second. If you take longer than usual, in their mind, they're not doing this every single day like you are. They might say, gosh, having to answer all those questions with another person again might be very discouraging for them, to the point where even if you're a beginner and you don't feel extremely comfortable in knowing everything, all the components of the lending transaction, but you do a very thorough job of just following the application questions, the person sitting across from you may feel, one, that you've invested a lot in them, two, might really like your personality, and three, definitely not something that they enjoy or want to do again, which means that the opportunity for you to earn the business just went up by about 10 times. So again, going back to me sitting with this individual, he told me, look, his mentor told me, the second the person has just a little bit of interest, immediately take the loan application. That was number one. It's huge. Just do that. Your business will 10x. Now, I want to share with you the next step. This is also very important because when you take the loan application, you have the opportunity to pull credit. And that's huge because pulling the credit is not something that this individual is going to want to do with multiple loan officers. They're only going to want to do it if and when they feel comfortable and they actually made some kind of a decision of wanting to work with you as a loan officer. Running credit is not something anyone should be doing on multiple occasions unless they're trying to extend credit. And the reason being is that it's a hard pull. It's an inquiry on your credit report. It's something that you're going to need to explain to the lender every single time. When they look at your credit report, they see who pulled your credit, and all the lender is really concerned with is that you extend credit. All right? Now, mind you, typically when you're shopping for a mortgage, you could pull credit 2 or 3 times. You really don't want to do that, but you could. It wouldn't affect you as much as just randomly shopping for a credit card or cars or different things, because it could hit your credit score. It could lower your credit score. But mind you, by pulling the credit, what exactly are you doing? You're pulling the client in a lot closer to you. Again, they're not going to want to pull credit with multiple people. So if they're already pulling credit with you and taking the application with you, again, your chances of actually going through a transaction with this individual has now gone up significantly. Hopefully that makes sense to you, because again, that's a commitment thing. The more you're able to make the borrower feel committed to working with you, you're not selling anything. You're just doing your job. You're trying to pre-approve them for a mortgage. And by asking all these questions, they're starting to feel a lot more committed to you. By pulling the credit, now not only are you pulling the credit, but you're going through the liabilities, trying to understand what it is that they're doing, what needs to get paid off, what already is paid off. Maybe there's things on the credit that don't belong there. It's another conversation that you can have. It's a different type of transaction altogether. Again, going back to sending somebody a link, fill it out. I'll let you know when it's done, and if everything looks good, we'll pull the credit. You see the difference? So that was number 2. I want to talk to you about number 3 for a second, which is getting their credit card information. Now, why is that important? Because there's only 2 things that are paid outside of closing, meaning things that you can pay for before you actually close escrow or upfront in some capacity. Number 1 is the credit. Now, mind you, credit could get quite expensive. Credit could be $70 for a single run or for a merged report. That's a lot of money. And guess what? As a producer, if you don't close the transaction, that comes out of your pocket. So I know we talked about running credit, but credit is the one thing that you can actually request a credit card for a borrower to pay up front simply because you're not a credit reporting agency. You're basically, this is how you explain it to the client. You're basically requesting a report from a third party so you can generate that report into your system and have the information that you need to make a preliminary decision on whether you could approve the client or not. Now, you don't have a decision to make a credit decision because you're not an underwriter, but you can give a pre-approval letter based on the information that you've received. So not to get too technical, but by getting the credit card information, you are now able to order the credit. And the reason I bring it in as number 3 is because once you have the credit card authorization on file, you let the borrower know that, hey, although we already ran your credit, but we're going to keep this credit card information on file. So once we disclose your loan to you and you acknowledge that you wish to proceed, taking 2 steps back, whenever you register a loan, disclosures go out. 2 specific documents need to be acknowledged before you're technically allowed to use a borrower's credit card to order an appraisal report. And that's where we're going with it. Again, paying a third party for their services to be able to use the report for the transaction. Now, the way we explain it is, whether we close escrow or not, the credit bureau does not care. They want to get paid for their third-party services. Same goes to an appraisal vendor. Whether you close escrow or not, they do not care. They went out to the property, they created a report, they want to get paid for their services. This is done upfront using the borrower's credit card, which is why having a credit card on file is huge, because now you've just gained another level of commitment. So recap. Number 1, loan application, in person, face-to-face, going through all the questions, getting a really clear understanding of the borrower, bringing them in to up your chances of working with them, up your chances of them not shopping 10 other lenders. Why? Because they feel super comfortable with you and they don't want to do this again. And number 2, running the credit, because we don't want additional credit inquiries for the file. And you explain that to them, that once they run the credit with you, oh, we've gone through this, now we have a full understanding on it. Mind you, only do this at the end. We don't want to run our credit again because it might lower our credit score. However, we don't need to, we're good to go. Typically, credit is good for 90 days, all right? In a transaction, it might be good for 60 days. So keep that in mind. And then lastly, having that same credit card on file, the one that we used to run the credit, so we can pay for the appraisal when that time comes, all right? So those are the 3 things. I think it's very important to, especially in today's environment, to really put these items in perspective, because you are spending so much of your time working with borrowers, working for commission only. So you got to make sure that your time is well spent. In this business, you typically do not get paid until the transaction is closed. So what I find is, if it's possible to build relationships with people that are going to send you slightly larger loan amounts, you might find that you're going to make more money spending the same amount of time. Now, there's an alternative to that. And if you're still watching this, then I think you should take note that if you're in the beginning journey of your career as a loan officer, then you have 2 paths ahead of you. Path number 1 is being a residential loan officer, which is basically everything we've gone through today. But path number 2 is being a commercial loan officer. Your earning potential as a commercial loan officer is significantly higher than it is as a residential loan officer. And let me explain to you why. Because typically for most banks, commercial banks, the minimum loan amount is $1 million. And a minimum baseline commission on a commercial transaction minimum is 1%, right? So 1% of $1 million is $10,000 commission, as opposed to working on a $300,000 or $400,000 residential refinance with significantly more competition. And when you factor in where we are in the market today, which is 2024, August 2024, And the reason I say that is because we've gone through 2020 through 2022, where a lot of people locked up interest rates as low as 2 to 4% for a period of 30 years. Well, in commercial lending, loans are only tied up typically for 3, 5, and 7 years. So that means that you have a lot more opportunity to refinance a loan simply because if they don't want to refinance, they have to sell. You see what I mean? It creates a tremendous opportunity for you. And let me assure you this, there's no shortage of commercial real estate. If you just go down to the boulevard, wherever you live, I mean, there's probably a laundry list of businesses there, and either they're renting or looking to transition to buy a location for their business. And if they're not, then the geographical area of where you work as a commercial loan officer typically is a lot larger than of a residential loan officer. There's a ton of opportunity there for you to make much larger commissions. The only reason I'm bringing this up is because I'm very particular with the amount of time that I like to spend as opposed to the amount of compensation that I'm going to get for it. If I'm going to work on a $200,000 or $300,000 refinance and it's going to take 30 to 60 days, depending on what they have going on, I would much rather spend that with a business owner on a transaction that's $2 to $3 million where I get paid 1%, maybe more, maybe 1.5%. And that would be basically like doing one deal as opposed to doing 10 little residential deals, all right? And you might be thinking, well, where would I learn how to do something like that? I've actually took 10 years of my knowledge in commercial lending and I packaged it into something that I call the part-time Commercial Lender Academy. And it's available via link in the description below. It's such a good academy because I've spent so much time putting it together in a way that is super easy to follow. And I've actually took all the forms that I've created, proprietary forms, and I plugged them into every section of this academy. So even as a beginner, you can learn how to do this, spend as much time as you need with me on video, 40 modules, which are easy to follow. So you could basically learn everything you need to know about becoming a commercial lender. All right, I'm going to end with that. I think this video has gone a little bit longer than what I've expected, but I know we've covered a lot. So if you have any questions, I encourage you, please drop them in the comments below. I'd love to know what you have to say. If you like this video, I would appreciate if you give it a thumbs up simply because there may be other people like yourself trying to find this type of information on the web. That would really help out. And if you enjoy videos like this in general, then please feel free to subscribe to my channel. I appreciate you being here. I appreciate you watching this. And I look forward to seeing you again on my next video. Take care.